I talked on a previous vlog or whatever you'd like to call this about inheritance tax, specifically the difference that the forthcoming inclusion of pensions, it's happening in 2027, as part of your estate when totting it up for the payment of inheritance tax is going to make. And the way in which we always used to and are now once again using good old-fashioned life assurance to provide funds to pay all or some of the tax that's now going to be due. Now that, in the case of a married couple, comes due when the second dies and everything passes on to usually the next generation. Now pensions and farmers have been in the news as the changes to the inheritance tax regime, perhaps with the highest profile, but there have been some others. The one that's most affected us of those others, and some of our clients too, has been that to AIM investments. Now AIM stands for the Alternative Investment Market. That's the layer below the main FTSE index. The entry level for many small companies going public for the first time. They were free of IHT, inheritance tax, or rather qualified for business property relief. So effectively no tax was payable once you'd held those shares for 2 years. That's changed, and AIM shares now only qualify for half the amount of relief, so 20% instead of 40%. We recommended AIM portfolios for those that could afford to take some risk over and above some of the other types of investment that could get you business property relief, because although you could never say they were safe, our view was that they were shares that were traded on the stock market, and so you and your beneficiaries could sell them if you needed to at whatever the price was, and hopefully at some time for more than you paid for them. The other types of shares which qualified, and actually still do qualify for business property relief, are unquoted shares. Now these could be shares in small family companies, for instance, and that's where the legislation was originally aimed. But there are also business property relief schemes now which have been put together for some years by specialist investment companies. Now these are typically a portfolio of small companies which the investment provider has actually started, and they invest in supposedly safe, steady areas. Examples are solar and wind farms, student accommodation and other sorts of properties like retirement villages, storage facilities, fibre optics for broadband. There's quite a range. Now they still get relief at 40% for investments up to £1 million. Then there are things called venture capital trusts and enterprise investment schemes, which have advantages for income and capital gains tax as well as inheritance tax. But here's the thing. You get those tax reliefs because you're taking a risk with your capital. Venture capital trusts and EISs, enterprise investment schemes, invest in real startups. Some, or you could say many of which, won't make it. Even if they do, getting your money out and being able to sell your shares is by no means a certainty. Now that's not always a problem for the people putting their money in to reduce inheritance tax, but it's a problem that can come into sharp focus when they have passed on and when those shares are then passed on to the family, who may find that they're either worthless or they can't sell them. And whose fault is that likely to be? Despite every risk warning we might have given, well, the advisor, of course. Which is why, coming full circle, good old life assurance is looking so good again, because it's simple and it works.